If you want to save money on your next car purchase, you will need to do more than strike a good deal with a salesperson on the sticker price. A mistake when taking out a car loan could cost you money and erase the savings you negotiated on the purchase price. Unfortunately, it's not all that uncommon, especially among borrowers with high credit scores. An investigation from Consumer Reports revealed that 3% of prime and super prime borrowers received auto loans with APRs of 10% or more, which is more than double the average rate for their credit scores. Not shopping around for the best deal on auto financing is just one mistake you want to avoid. And here are some of the others to avoid if you want to land the best possible deal. I'll tell you all about it, but first I want to remind you to subscribe and click that little bell for notifications so you don't miss anything. We give you more than car reviews and first looks of new vehicles. We give you car smarts because knowledge is power. Dealership financing is an easy and convenient way to get a car loan, but it also comes at an added cost. Dealers often mark their rates up by a few percentage points to ensure they get profit. Before visiting the dealership, shop around and get a few quotes from banks and credit unions, and doing so will give you an idea of the interest rates available for your credit score and ensure that you get the best deal. Keep in mind, those bank requirements may be stricter than credit unions, but they offer better rates that you won't find at a dealership. If it's your first time purchasing a vehicle, look for financing programs for first-time buyers at credit unions and at the dealership. Once you are pre-approved for a loan, you can negotiate with the dealership more effectively. After all, if the dealership isn't willing to beat the rate you already have, you don't have to rely on their financing to get the car you want, and that will cost them money. Although the monthly payment of your car loan is important, you should know in advance how much you can afford each month. It shouldn't be the basis of the price you negotiate. Once you volunteer how much you can afford per month, the dealer will know how much you're willing to spend, and the salesperson could also try to hide other costs, such as higher interest rates and add-ons. They might also pitch you on a longer repayment timeline, which will keep the monthly payment within your budget, but cost you more overall, and that needs to be avoided. To avoid this, negotiate the vehicle's purchase price and each of the fees with the dealership separately so you can focus on your monthly payment, and that will save you money. Your creditworthiness determines your interest rate, and a borrower with a high credit score qualifies for a better car loan rate than one with a lower score. And shaving just 1% point of interest from a $15,000 car over 60 months could save you hundreds of dollars in interest paid over the life of that loan. Knowing your credit score ahead of time will put you in the driver's seat in terms of negotiation. Whether you use Credit Karma or check with your bank, you need to know that number. And with it, you'll know what the rate is and what you can expect. And if the dealer is trying to overcharge you or lie about what you can qualify for, you'll know the facts. New auto loans had an average rate of 6.07% in the fourth quarter of 2022, according to data from Experian. And people with excellent credit qualified for rates around 3.84%, while people with bad credit had an average new car rate of 12.93% interest. Rates for used cars were higher at 10.26% across average credit scores, and the average rate for bad credit was a sky-high 20.62%. So bad annual percentage rate for a car would be on the upper end of those numbers. Legally, loans can't have an APR over 36%, so seek a lender that offers you an average rate for your credit score and then shop around to get the best rates. Car loan terms range from 24 to 84 months, which is not acceptable. Don't go beyond 5 years. And longer terms may offer tempting lower numbers in payments, but the longer you spend repaying your loan, the more interest you're going to pay, and that only helps the bank. Some lenders also charge a higher interest rate if you opt for the extended repayment period, since there's a greater risk you'll become upside down on the loan, which is why you don't want to go with the longer term. To decide which is the best option for you, consider these priorities. For example, if you're the type of driver interested in getting behind the wheel of a new vehicle every few months, being trapped in a long-term loan might not be right for you. On the other hand, if you have a limited budget, a longer term might be the only way you can afford this particular vehicle. Use a car finance calculator to understand your monthly payment and decide which option is best for you in advance. A short-term loan will cost you less in interest overall, but you'll have higher monthly payments. A long-term loan will have lower monthly payments, but higher interest rates over time, and that will cost you more money. Dealerships profit from add-on sales, especially aftermarket products sold through the F&I office or finance and insurance. And if you want an extended warranty or gap insurance in case you lose your job, these items are available at a lower cost from sources outside the dealership. Now, wrapping these add-ons into your financing will also cost you more in the long run, since you'll be charged interest rates on each one of those, and that's going to cost you even more money. Question every fee you don't understand to avoid unnecessary additions to your purchase price. And if there is an add-on you truly want, pay for it out of pocket. Better yet, check if it's available outside the dealership for less. Buying from a third party is often cheaper for aftermarket products, extended warranties, and gap insurance. In the long run, financing add-ons will lead to more interest paid overall. Come prepared with negotiation tools, knowing which add-ons you truly need and which you could find elsewhere for a lot less money. Being upside down in your car loan is when you owe more on it than it's worth, and lenders may allow you to roll over that negative equity into the next loan. That is not a smart financial move, and if you do it, you will pay interest on both the current vehicle and the previous vehicle you just traded in. And if you're upside down on your last trade-in, chances are you will be again. Instead of rolling that negative equity into your new loan, try paying it off, so once that old loan is done, you won't be taking it on to the new loan, and you can also pay off your negative equity up front to the dealer to avoid paying excess interest. That is an option if you can afford it. The key to success when taking out a car loan is preparedness. This means negotiating the monthly payment, knowing your credit score, choosing the right term length, being aware of add-on costs, and avoiding rollover negative equity. Keep potential mistakes in mind while you negotiate, and with luck, you will walk away with saving money and saving time. If you like this video, give it a like and subscribe for more videos like this one. If you have any questions or comments, I'll be more than happy to answer them. You can support me by buying me a cup of coffee. The link for that is in the description, plus all the links for our website, social media, my book, and the podcast. I'm Lauren Fix. Thank you so much for watching.